Good afternoon. Good afternoon. It's Monday, the 5th of May. Welcome to another edition of Monday Market Picks. My name is TLI Vikramasinghe. I'm the head of research for Maybank Securities in Singapore. Trump is suggesting some trade deals will be possible as early as this week. Will this be enough to put market volatility at rest? Voters across a few countries from Australia to Canada and this weekend in Singapore don't seem to think so, and they have been giving the incumbent political parties a larger mandate, hoping that they can handle this uncertainty going forward. So in today's show, we will look at how we should be reading Singapore's general election over the weekend, and then shift our attention to the S-REITs, which is mostly done with reporting season. We have Krishna joining us for some comments. Then we go on to Hussaini, who's going to talk about Grab's very, very strong results, as well as some interesting news on the ASEAN data center sector. And then we also look at Wilmar's results to see what Chinese consumers are feeling right now. Plus, we've got a couple of new trading ideas from our chart guy. And we also have a very interesting initiation from Thailand as well. So let's start with Singapore. When we look at this weekend's general election, we see a very strong mandate for the incumbent government and for Prime Minister Lawrence Wong. Now, when we look at the past 10 election cycles, the election outcome, whether it was a huge margin or a narrow margin, has very little impact on the STI, particularly on a 3-month scale. In fact, today, the STI is pretty much flat so far. Now, having said that, this particular result does send a very strong signal that there is a strong mandate for the current government to deal with Trump-led uncertainty. This reinforces stability and political and policy continuity in Singapore, which we think will attract safe haven flows, as we have seen in past stress situations like COVID and during the interest rate hikes as well. Plus, this could give the government additional legitimacy if they need to deploy more fiscal stimulus or even draw down from past reserves in an extreme situation. We have seen that happen during GFC. The government did increase their direct stimulus to about 7.6% of GDP, plus they drew down about 1.5% of GDP from past reserves. During COVID, this was even higher, with about 14% direct stimulus and another 8% GDP in terms of drawing down from past reserves. Plus, the current government budget actually has a fiscal surplus of another 14 billion Sing dollars that can be drawn down this year if there is a need to provide additional support if you see global volatility increasing. So we think all of this should support domestic resilience in Singapore, and that's a theme that we have been highlighting quite a bit this year. Last week, we highlighted a screen across SGX stocks, both rated and non-rated stocks of companies that derive more than 50% of their revenues from Singapore. Of the 40 names that came up, around half of those were REITs as well as real estate names. So we'll have Krishna later on to provide some comments on the sector. But in terms of some of the stock names that we highlighted, CICT, FCT, KREIT, and Impact are some of those names that come up on our list. We also saw several property development names, as well as construction names, as well as related names to those sectors like Bukit Sembawang, BRC Asia, Wing Tai, and OUE. Some of the industrial as well as utilities names were also featured, particularly those with large domestic utilities contracts and order books. So Sembcorp and Keppel are some of those names. And consumer and healthcare names also screened particularly well, especially names like Shen Xiong, Kimley, Raffles Medical, Thomson Medical, as well as TalkMed. Finally, we saw some domestic transportation names like Comfort Delgro, SBS, and Vicom, as well as media names like StarHub also featuring quite well in that list. So I do suggest having a look at that list in a much more detailed way in our note in today's newsletter as well. Now let's move on to the S-REITs. Now, we have Krishna joining us for this. Krishna, with the reporting season almost done for the sector, what key trends have you seen and what are you taking away from this?
Yeah, thank you, Tilan. Thank you for having me once again. So the quarter that we see is pretty much in line with what we were expecting, and also to the continuation of the prior trend. So we are seeing the Singapore-focused names in retail and healthcare. They did relatively well. Those who reported distribution, they did see a growth as well. In contrast, the overseas performance continued to suffer. Industrial saw mixed performance, and healthcare, the hospitality was decidedly weaker. On operation side, we are seeing some weakness, even in the domestic theme as well. I mean, retail sales, they continue to slow down. And there has been some occupancy slippages happening across subsectors. On the brighter side, what we are seeing, and this is in line with the expectation, what we have told clients as well, is the borrowing costs came down sequentially. And this is for most names. And what we are seeing is on the hospitality side, things have been a lot more visible because they do have a high proportion of floating rate debts. Guidance-wise, I think macro uncertainties, in my view, did weigh on some of the guidance. Most REIT managers kind of are both on the operational side and the borrowing cost side, or on the wait and watch mode to see how these uncertainties kind of evolve. And one thing which has come out very clearly is the investment and divestment activity of all REITs are on a slow track because buyers and sellers are revisiting the underwriting assumptions given these uncertainties. So that's, I think, is what will be my takeaway from the REIT results and business updates and the guidance which managers have shared in this quarter.
Okay, that's interesting. I mean, a little bit more cautious guidance and so on. So, but when you think about the different REIT subsectors, where do you think, which subsectors do you think have the weakest fundamentals, and also which subsectors have the strongest fundamentals?
Yeah, so I think, as I mentioned, that retail and healthcare, they have reported stable bottom line compared to your office, industrial and hospitality. So headline-wise, we are seeing retail and healthcare to be the strongest. But as I mentioned, that some of the operating trends are seeing persistent weakness. So it is just that we need to keep an eye on them and just see if we are under discounting any of those risks. But right now, clearly from this quarter, it continues to be retail and healthcare having the strongest of the fundamentals, and then office, industrial, and healthcare on the other side of things.
Got it. And what are your key picks for the sector after these results?
Yeah, so we are sticking to our theme of being positive on the sector, but being selective on the names. I think what decidedly one thing which has come across even after the April 9 turbulence is that Sing dollar has strengthened. It is now trading below 130, and we have seen that strength in some of the regional currencies as well. So safe haven flows should be there. You have already mentioned about potential fiscal stimulus. So I think that should be positive for the sector. But given these uncertainties, I think we are putting a bit more of premium on liquidity. So our preference of the domestic focus large caps and select high yielders continue. So our stock picks will be CICT, CLAR, FCT, Impact, MLT, and Parkway PREIT. So we are sticking with our selected names for the REIT sector.
Okay. Now, I just want to change a little bit of tack and talk about CLI. Now, this was a result that was a bit disappointing for the market. We saw a fairly negative reaction to that, but you're actually still keeping your buy recommendation. So what's driving this?
Yeah, so I think just to be clear, CLI reported their business update, so didn't have any earnings, but the revenue that came in, you are right that on a headline basis, they did see a sharp drop. But part of that is also because they had some impact from accounting. They deconsolidated a REIT that they own. Therefore, there was an impact of that. But if you take that effect out, the revenue line was flat year on year. But having said that, yes, some of the key operating trends were relatively weak. And then that goes down to what I had mentioned earlier, that on the transaction side, things are slowing down. As I said, the buyers and sellers are taking a bit more of time to come to the table. So that has impacted CLI. Now as you mentioned, there has been some of a stock price reaction as well, but that also came on the back of the Friday being the day on which they went ex-div. But we are keeping our buy rating, and the reasons for that are, if you see the stock price right now, it is pretty close to the tangible book. And management is executing on its strategy of diversifying away from China, also diversifying its product portfolio, moving more towards the private funds, private credit theme. And as well as you are seeing some of the expanding capital partners as well. So they are able to get some of the domestic funds in China in their network. So we are keeping our cautious optimism stance on the name. They have announced some acquisitions late last year, which should become effective from the second half. I think that should help shore up the financials for the full year. So it is foggy, but we hope that our expectation is that some of these risks are currently being discounted by the share price.
Got it. Thanks, Krishna, for that. That was Krishna, S Street analyst. Now let's turn to Wilmar. Wilmar also reported their first quarter results, and that was in line with expectations, and revenues were up about 3% year on year. We actually saw sales volumes increase across all segments except for sugar, and sugar was mostly because there was a lot of front loading happening in the fourth quarter. And the key thing that I want to highlight is that the food product segment volumes increased, showing that there is higher demand in China. Now, why do I say that? If you look at Wilmar's staple products, while they sell cooking oil and while they sell rice and wheat, flour, they are considered branded. And so if a consumer in China is buying branded staples as opposed to generic or stuff that is not in the supermarkets, that shows that they're feeling a little bit more confident in terms of the outlook for themselves and the economy. So I think that's a positive sign that we're seeing in Wilmar. Of course, the elephant in the room is US tariffs on China, but the management tone was actually quite cautiously optimistic. Now, take soybeans, for example. While they have stopped sourcing soybeans from the US, given the big import tariffs that China has imposed, they're getting ample supplies from Latin America. This is actually leading them to have better crushing margins. So, given Wilmar supplies mostly domestic consumption in emerging markets like China, India, Indonesia, and US sales are only about 2% of overall revenues, they should be more resilient in this sort of trade war sort of environment. So we are keeping our buy rating on this stock. So do have a look at our note in the newsletter today. Now let's turn to Hussaini. Hussaini, Grab had a very strong first quarter results. What were the key drivers behind this?
Yeah, sure. Thanks, Thilan, for having me. So, a solid results from Grab, no question. GMV grew by 16% year on year and came 1% ahead of expectations. Now, this underscores that there were limited signs of growth slowdown in the wake of tariff or macro uncertainties. But where we were most surprised was the monetization and cost control. So adjusted EBITDA expanded 71% year on year and came 9 to 12% ahead of our and street expectations. And key driver were slower incentive expansion, which reflects a stable competition and also a smaller expansion in regional or head office costs. So those factors help to draw a faster EBITDA growth.
Got it. And how has management guidance changed, and how should we read that into going into second quarter?
Now, this was another positive surprise. So, see, before the results, the key debate was whether management is going to retain the guidance or cut the guidance, given macro and tariff uncertainties. On the contrary, management raised the guidance, EBITDA guidance, from 440 to 470 million USD to 460 to 480 million USD. And this underscores that management is quite confident about the sustainability of growth. On second quarter, see, first quarter was a seasonally soft, particularly owing to Lebanon, which was in this year, it was mostly in first quarter. So going into second quarter, there is a strong recovery expected. Management also highlighted that in April, they see a very strong recovery as per the projections. So we expect a strong recovery going into second quarter. Maybe one last point to note is that there is a Food Panda announced that they are going to exit Thailand, and Deliveroo as well sold their business to DoorDash. So that also raises some confidence of further softening in competition, leading to a more or superior growth for Grab.
Got it. Now, I mean, when you think about Grab, and they operate in all over Southeast Asia, and all these Southeast Asian countries have different levels of tariffs and different cycles of negotiations. So what are the risks of Grab operating right now in the region?
Maybe to start with, first of all, Grab so far has not seen any growth slowdown. Okay. But nevertheless, we ran our sensitivity analysis on the downside risk, assuming that if macro turns a sharp turn. In our worst case analysis or scenario, we see 18% downside risk to Grab's adjusted EBITDA and 16% downside risk to share price. Now, this factors in a growth slowdown of 20% and no more monetization initiatives. What management highlighted in the call, and that is very important, is that Grab is counter-cyclical in nature, in the sense that during times of macro weakness, they see driver supply increases, which in turn helps to bring down the prices and thereby boosting demand. So those are the factors, and as such, the risk on the downside due to macro or tariff uncertainties is limited.
Got it. Now let's quickly turn to data centers now, and it's a big theme in Southeast Asia. You highlighted that the UAE might actually reach AI chip supply deal with the US. Now, ASEAN is not close to a deal. So do you think this might actually drive a deal in ASEAN as well?
Yeah, sure. So maybe if we take a step back, so in January this year, US announced an AI diffusion framework, thereby restricting exports of advanced AI chips. And that raised concerns on the supply side of further data center development in ASEAN. UAE is also subject to similar restrictions. Now, what is happening right now is that last week, there was a news article in Bloomberg that UAE and US may come to a deal when President Trump visits Gulf nations. So, and as per the deal, US may lift the export restrictions on UAE. It's more of a bilateral negotiation and sounds positive for data center development in UAE.
Got it. Got it. Now, all the cloud majors have reported, and generally, the conclusion is that the deployment of data centers does not look to be slowing down. So, in that sort of context, who are the beneficiaries in Southeast Asia?
Yeah, so see, most of the beneficiaries in Southeast Asia are the companies in the supply chain of data center development. Now, because of the AI diffusion framework and these macro and tariff concerns, those companies took quite a bit of hit. And we see that those dips are a good opportunity to buy those names. Few of the names we highlighted in the supply chain are the likes of Gamuda and IJM Corp in Malaysia. Similarly, Tenaga as well in the utility space. In Singapore, CSC Global and Singtel are the potential beneficiaries of data center demand side growth.
Great. Thanks, Hussaini, for joining us. Let's have a quick look at our chart guys' technical ideas. We've got two accumulates. One is VALUETRONICS. He's looking for another green candle, which could start another leg up for VALUETRONICS. And then he also has accumulate or a trading buy on TUAN. The stock's rebound from its previous support at 21 cents appears poised to resume, he says. So do have a look at the more detailed technical charts in our newsletter. Now, before we go, I just want to quickly highlight a new initiation in Thailand on Thai life insurance with a 16 baht target price, which is about 30% higher than the current price. They are the biggest life insurance company in Thailand in terms of a domestic life insurance company. They have the highest margin in value of new business in the region. They also have the strong capital base, which means that they can up dividends a lot more than what they are paying right now. And the new FRS 17 accounting standards, which will come into force for them by around mid-May, which should help them restate their earnings higher. Peers like Muang Thai saw a 21% uplift to their earnings, and for Krung Thai, AXA saw a 261% increase to their earnings. We are only penciling in about a 7% upgrade to our EPS right now, so there is room for more to come. The stock's trading at 0.75 times price to embedded value, which is the present value of all the insurance businesses, compared to about 1.1 times for AIA. So fairly well valued right now. So do have a look at our initiation report there. In terms of upcoming results, we got banks results all coming out this week, UOB, DBS, OCBC. We all think that the three banks will have pretty strong one-quarter results, but we are all watching out for a lot more subdued guidance going into the second half, particularly in terms of asset quality as well. We also have StarHub reporting on the 9th of May and FLCT out on the 7th. With that, that's all the time we have today. Thank you so much for joining us. Have a profitable trading week, and we will not see you next week because Monday is a holiday. We'll see you the following week.